Hi, welcome to the Magpie YouTube channel. I'm Anthony Tran, Magpie Invest Strategist. In today's video, I'm going to talk about why interest rates are so important to us, what central banks can do to manage interest rates, and the winners during the current interest rate hike cycle. So what is interest? For example, if you save $100 in the bank this year, then next year you get $105. Then the interest that you earn is $5, and the interest rate, usually expressed in an annual basis, is 5%. This works the other way around too. If you borrow $100 from a bank today and you agree to return $105 next year, then the interest rate will be 5%. Simply put, interest is the cost of future money available today. So, if interest rate is reduced from 5% to 0%, ceteris paribus, everyone with money in hand will have little motivation to put the money in the bank. Instead, they'll prefer to spend the money, and many will even borrow at zero cost to spend more and invest. Compared to the time when the interest rate was 5%, more companies will take out loans with zero interest to expand their production by hiring more people and buying more machines. Listed companies will also use the cheap money to buy back their shares to boost share performance, and investors will tend to buy more stocks looking for higher returns. On the consumer side, if more people take out loans to buy houses, then property developers such as Sun Hung Kai will earn more. This can also be the case for Tesla and Louis Vuitton as people buy new energy cars and designer handbags with consumer loans. Therefore, the entire economy will become more active, and this will create a virtuous cycle with companies earning more as people spend and invest more. This was evident in the US economy in 2021 when the Fed funds rate was held lower than 0.1% in a bid to boost the economy when the COVID pandemic kicked in. At that time, other central banks, such as the European Central Bank and the Bank of England, also cut interest rates to ultra-low levels to stimulate the economy. So, it looks relatively easy for central banks to cut rates to stimulate the economy, right? Beneath the power of low interest rates, however, lies a string of caveats, notably inflation. With more money, people tend to buy more and increase prices of consumer goods. Companies need to increase their production to meet the demand and buy more materials as well. After all, everything gets more expensive, and this causes higher inflation, which in turn erodes the purchasing power of cash. To put a brake on an overheating economy, central banks can do the other way around by raising interest rates. This is why recently, the US and Europe have started raising interest rates since they can see record high inflation kicking in. Interest rates that we pay for loans largely consists of three parts, and what central banks can increase or decrease is the risk-free rate, which is the foundation of the entire economy. In other words, savings rates, credit card rates, and mortgage rates, together with corporate bond interest rates, are all influenced by the risk-free rate. It is the interest rate on assets that are deemed completely free of risk. In reality, the closest thing to risk-free assets are the bonds issued by large economies. These government bonds are frequently traded in the secondary market with floating prices and yields. For instance, when the 10-year Treasury price is $102.6, then the corresponding yield will be 3.81%, which can be used as the risk-free rate for a 10-year loan. If we plot these yields of bonds having equal credit quality but different durations, from the shortest duration on the left and the longest one on the right, then it will represent a yield curve that gives an idea of future interest rate changes and also economic activity. Out of these various interest rates, only very short-term interest rates are controlled by the respective central bank. As seen in the US yield curve, it is only the Fed fund rate and overnight one-day interest rate that is directly controlled by the Federal Reserve, and it is the interest rate that always appears in news headlines. The interest rate of longer duration risk-free bonds, on the other hand, are determined by the Treasury markets. In other words, these interest rates are not directly controlled by the Fed. While central banks cannot directly control longer-term interest rates, they can affect these rates by printing new money and buying government bonds in the open market to drive up their prices. By doing so, long-term yields will be pushed lower. During an interest rate hike cycle, market participants expect the Fed to continue raising the Fed fund rates to contain inflation. With higher borrowing costs, which is an upward shift in the yield curve, consumers and corporations tend to pay back their loans to avoid high interest expenses, and they tend to save more money by depositing their money in the bank, spend less, and thus lowering inflation. Rising interest rates also make newly issued government bonds more attractive than the old ones, thus pushing the prices of existing bonds lower. This can be seen in the impressive performance of the Direction Daily 20+ Year Treasury Bear 3 times, which is an inverse ETF that has been rising on the falling prices of long-term US Treasuries. For the stock market, however, the relationship between share prices and interest rates is less direct. Theoretically, with high interest rates, the interest cost of borrowing money for business expansion should be higher, thus eroding corporate earnings. This negative effect is more pertinent to companies with higher debt ratios. However, there are always other factors that can affect stock market performance, such as overall economic performance, demographic trends, and market sentiment. This year, for example, the fall in US equities is largely due to the extremely expensive valuation that the stock market reached in early 2022. The earnings of companies that rely on consumer loans such as luxury cars, houses, gaming, and designer handbags will be hurt. Companies that are not yet profitable has also been hit hard, since their future earnings are discounted more heavily by higher interest rates. On the other hand, dividend-paying stocks, as well as companies that have stable cash inflows, such as insurance and energy companies, tend to be preferred during a rate hike cycle. In brief, we expect equity markets to remain volatile this year. Investors should stay vigilant and manage their risks. Thank you for watching. I hope you enjoyed this video. See you next time.